Professor Steve Keen's provocative claim that Bitcoin could eventually drop to zero isn't tied to common concerns like regulation or competition. Instead, he identifies energy as the critical factor, specifically the finite U.S. power infrastructure that Bitcoin may one day have to share with artificial intelligence. This argument shifts the focus from theoretical debates to the practical constraints of capacity. The issue isn't whether Bitcoin or cryptocurrency more broadly works in theory versus AI being more important because it's believed that it will transform the global economy. From his point of view, it's about what happens when both technologies demand more from physical systems than those systems can provide. In response to Professor Keen's concern, I think we've become accustomed to evaluating technologies based on their narrative, valuation, and adoption potential. But infrastructure doesn't respond to potential. It responds to load and transactional value. At some point, the demands placed on energy systems and the tangible value derived from them force critical decisions. Although I have not conducted an in-depth energy consumption comparison between Bitcoin and AI, the fundamental reality remains. Both systems are energy intensive, and the grid they rely on is not infinite. While countries like China are modernizing their infrastructure at a rapid pace, the US appears to lag behind, raising questions about its readiness to meet the growing demands of technologies like AI and Bitcoin. Artificial intelligence is being positioned as essential. It's central to conversations about productivity, competitiveness, and future economic growth. Governments are backing it, and significant capital is flowing into it, leaving little doubt about its perceived necessity. Bitcoin, on the other hand, occupies a more ambiguous space. It has achieved cultural significance, financial relevance, and political attention, as evidenced by the crypto industry's lobbying efforts during the 2024 general election and policy developments like the Genius Act. However, legitimacy is not the same as reliance. Despite its visibility and valuation, Bitcoin's real-world usage, particularly in global transaction significance, remains elusive. The past 2 years have served as a stress test for any system claiming to be a decentralized alternative to traditional finance. Global instability, wars, sanctions, commodity shocks, and shifting alliances have created opportunities for new forms of currency to emerge. Yet in these moments, traditional assets like gold, oil, and other tangible resources have reasserted their dominance. Bitcoin's price may rise at times, but price movement is not equivalent to functional adoption. I am aware my skepticism is rooted in a fundamentalist approach to investing, one that prioritizes financial transparency and leadership accountability. Bitcoin, lacking these qualities, feels incomplete as an investment. While I acknowledge this bias, I also recognize Bitcoin and blockchain's contributions to the broader conversation around tokenization, fractional ownership, and digital financial systems. These innovations matter, but contributing to a conversation is not the same as becoming embedded in the systems that govern real-world exchange. My particularly unfiltered take is that Bitcoin increasingly behaves like an S&P prop. When traditional markets face pressure, Bitcoin's movements often resemble those of a reactive financial asset rather than an independent monetary system. This raises critical questions about its role. Is it a currency or merely a volatility instrument? The distinction matters, especially when thinking through Professor Keen's energy constraint. If both Bitcoin and AI continue to scale without a corresponding expansion in infrastructure, prioritization becomes inevitable. Decisions won't hinge on ideology or innovation, but on perceived necessity. Which systems are indispensable? Which justify their energy consumption not just in theory, but in practice? These are the questions that matter most, especially as we face the limits of our physical systems. Several unanswered questions emerge after thinking through Professor Keen's assertion. What criteria will determine which technology gets priority in a constrained infrastructure system? Can Bitcoin survive as a store of value without meaningful global transactional relevance? What would real geopolitical adoption of Bitcoin look like in practice? Are we overestimating decentralization's power while underestimating the importance of physical infrastructure? When does legitimacy come from actual usage rather than narrative or policy support? And if Bitcoin hasn't fully realized its most ambitious use cases after nearly 2 decades, what catalyst could change its trajectory? In systems under pressure, belief doesn't allocate resources, capacity does. The fundamental question remains, When resources are constrained, which systems prove indispensable?